Hi guys, this is 𝗙cie Balakrishna kovuru from lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the previous class, we have started with chapter 1 of Companies Act, right? Appointment and qualification of directors. Now we will be starting with the second chapter of Companies Act for CA final level, that is self-paced online module set A. And obviously these classes they can be used even by CMA students as well. Okay, and we'll be as usual discussing the concepts from the handwritten charts that I have prepared, and you can get these handwritten charts from our Telegram channel, and also the link that is available in the description. Okay, now today we'll be starting with the second chapter, which is appointment and remuneration of managerial personnel. So here we need to first of all understand who are these managerial personnel. Basically, by going through that terminology, managerial personnel means the people who are involved in managing the business of the company will be known as managerial personnel, right? Basically, as per Companies Act, there are 6 people that has been prescribed as managerial personnel. We will be calling them as key managerial personnel, KMP. Section number 203 deals with this concept. Okay, we will be discussing who are these 6 people who will be known as managerial personnel or key managerial personnel. Now in this chapter, in this second chapter, we will be having 10 sections. Section number 196 to section number 205. Okay, these 10 sections we'll be discussing in this chapter. Now before entering into the chapter, we'll first of all understand certain basic terminologies which are very much essential to understand the concepts that we are going to discuss in this chapter. Okay, these are the basic terminologies that we'll be using in this chapter. So starting with executive director versus non-executive director. Basically there are these two terminologies that we will be using in this chapter. One is executive director and another one is non-executive director. So what is the difference between executive director and non-executive director? Basically, managing director and whole time director, these two directors will be known as executive directors. Okay, managing director, whole time director will be known as executive directors. Apart from these two directors, remaining all other directors will be known as non-executive directors. Now what is the difference between managing director, whole time director and all other directors? Basically, the normal directors, that is non-executive directors, they will be involved only in decision making activity. Okay, non-executive directors will be involved only in decision making activity, whereas executive directors will involve in decision making activity, and they will also be in the employment of the company. So first of all, as we discussed in the first chapter, directors will be involved in decision making. The function or the purpose of appointing the directors is to make various decisions with respect to the business of the company, right? So these decisions, so both executive director and non-executive director, they will be involved in the decision making activity, but executive director, apart from involving in decision making activity, he will also be in the employment of the company. Okay, so executive directors are employee of the company, whereas non-executive director, other directors like independent director, women director, okay, all other remaining types of directors, they are not employees of the company, whereas managing director, whole time director will be employees of the company. Hope that is clear. So executive directors will be managing director and whole time director. Why? Because apart from involving in decision making, they are also in employment with the company. Okay, they are also in employment with the company, so they are executive directors. Hope now you understood the difference between executive director and non-executive director. The difference is the employment. Okay, executive director will be employee of the company, whereas non-executive director will not be in the employment with the company. Hope that is clear. So here you can conclude that executive director will be non-executive director, plus if you add employment to him, he will become executive director. Okay, now normally, as discussed in chapter 1, director will be appointed under section 160 through a ordinary resolution of shareholders in a general meeting, right? So generally a non-executive director, a normal director will be appointed under section 160 through general meeting ordinary resolution. Now if you wanted to give employment to that non-executive director, that means if you wanted to convert that non-executive director to a executive director, that means you wanted to make the existing director as a managing director or the whole time director. In such a situation, section number 196 has to be followed. Okay, section number 196 deals with appointment of managing director, whole time director, or manager. Manager is another position. Even manager will be treated as executive director. Okay, these three people will be executive directors. Hope that is clear. Now if you wanted to appoint executive director, how you have to which type of resolution is required, what section number 196 says? Let's see. I hope you understood the difference between executive director and non-executive director. The difference is the employment. Non-executive director, generally as per section number 160, you will appoint by passing general meeting ordinary resolution. How you will appoint the executive director, that we will be discussing in section number 196. Okay. Now, so in order to appoint a person as a executive director, if his age is 21 to 70 years, okay, if the age of the person is 21 years to 70 years, and if you wanted to appoint that person as an executive director, then first of all board meeting ordinary resolution is required, right? First of all, board of directors have to recommend a particular director as a non-executive director. So for such recommendation, ordinary resolution is required. After the board of directors have recommended, it has to be approved by shareholders, again by general meeting ordinary resolution under section 196. So for appointing an executive director, you will be requiring general meeting ordinary resolution along with board meeting ordinary resolution. Okay, now generally if you see how you will appoint an executive director, the practical scenario how it will work, let me tell you. Appointment of executive director. See, executive director in the sense managing director or the whole time director or the manager. Okay, how these people will be appointed? First of all, there will be board of directors, right? Every company will be having board of directors, right? Let's say in the board of directors there are 5 directors: Mr. A, Mr. B, Mr. C, Mr. D, Mr. E. These are the 5 directors, okay, who are normal directors, non-executive directors. Now board of directors wanted to appoint executive director. So here they are having two options to appoint executive director. Okay, whenever I use the term executive director, you have to understand it as either managing director, whole time director, or manager. Okay, These three people can be called as executive directors. Okay. Now, board of directors wanted to appoint an executive director. They are having two options before them. The first option is among themselves, they can promote one of the director as executive director. Okay. Now, there are A, B, C, D, and E, who are five non-executive directors. Among these five people, let's say all the directors decided to promote Mr. C as executive director. Okay. So for this, what they can do? First of all, board of directors through board meeting ordinary resolution will recommend to shareholders to appoint Mr. C as executive director. Once it has been recommended to shareholders, now shareholders, if they are okay to appoint Mr. C as executive director, they, by passing general meeting ordinary resolution under section 196, they will appoint Mr. C as executive director. Okay. So this is when existing director has been promoted to executive director. This is a one situation. The second option that is available to board of directors is they can search some other person who is not a director of the company. Okay. Let's say Mr. X. All the board of directors, they found that Mr. X is very intelligent person and he is having lot of experience in the area in which the area of business of the company. So board of directors wanted to appoint Mr. X as executive director. Now again, what they will do? Board of directors through board meeting ordinary resolution, they will recommend Mr. X as director to shareholders. Okay. Then if shareholders agree to appoint, if shareholders are also willing to appoint Mr. X as a director, then they will pass ordinary resolution in the general meeting under section 196 and they will appoint Mr. X as executive director. Okay. So these are the two scenarios. Okay. The practically these are the two options that are available. Okay. And the requirement is that in order to appoint a person as an executive director, his age should be 21 years to 70 years. Okay. So if the age of person is 21 years to 70 years, and if you want to appoint such person as an executive director, general meeting ordinary resolution sufficient. Hope that is clear. Now let's say age of a particular person is 75 years, that means above 70 years, but company wanted to appoint that person whose age is above 70 years as executive director, whether they can appoint or not. What section number 196 says is, if you want to appoint a person as an executive director whose age is above 70 years, then you will require general meeting special resolution. Okay. In the normal situation, through general meeting ordinary resolution, you can appoint executive director. But if his age crosses the 70 years, then you will require general meeting special resolution. Hope that is clear. Now, another situation. The age of particular person, Mr. X, is 75 years. Now, the company wanted to appoint this person as a executive director. For this, it requires a general meeting special resolution. But it got general meeting ordinary resolution. Okay. If you want to appoint a person whose age is above 70 years, general meeting special resolution is required. But shareholders gave only ordinary resolution. That means only more than 50% of the shareholders agreed to appoint Mr. X whose age is above 75 years. In this situation, since a special resolution is not given by the shareholders, okay, since the shareholders have not passed the special resolution, in this situation, by adding central government approval to the ordinary resolution, they can appoint the person whose age exceeds 70 years as executive director. Hope that is clear. So there are two options to appoint a person whose age is above 70 years as an executive director. What are those two options? First option is straightforward, general meeting, special resolution. Second option, if in general meeting shareholders have not passed special resolution but they have passed only ordinary resolution, in such a situation, general meeting ordinary resolution along with the central government approval, you can appoint such a person whose age is above 70 years as executive director. Hope that is clear. So this is with respect to the appointment of executive director in the two situations, age 21 to 70 years and age 70 and above, board meeting ordinary resolution, general meeting special resolution. First option, if general meeting special resolution not received, then general meeting ordinary resolution plus central government approval. If general meeting ordinary resolution also not received, in that case you cannot appoint such person as a executive director. Hope that is clear. Okay, now section number 196 is dealing with appointment of managing director, whole time director and manager. Here you might be getting a doubt of what is the difference between managing director, whole time director and manager. See, basically these three are the positions. Okay, these three are the positions that are available at the company. You can fill these positions. Now, what are the difference between these positions? Let me tell you. Okay, difference between managing directors. Okay, here managing director in the sense both MD, WTD and manager. Okay, what is the difference between these two positions? Let's see. First of all, the person whom you are going to appoint as a managing director or whole-time director, he should first of all be director of the company. Okay, he must be a director of the company. Whereas the person whom you are going to appoint as a manager, he need not be director of a company. Okay, he can be either director of a company or he need not be director of the company. Okay, that is your wish. If you want to appoint a director of the company as a manager, you can appoint. If you want to appoint some other person as manager of the company, you can appoint. See, here you should not confuse. The term manager is not the general term. Like in case of companies, you will be finding general manager position, purchase manager, accounts manager. Okay, this is not that type of manager. Okay, the type of manager that we are discussing in section number 196 is not that type of manager. Okay, here this manager is the managerial personnel who will be having powers to take the decision at the entire company level. Okay, he is the executive director. Okay, here this manager is executive person of the company. He is not a general manager that you will be listening like a purchase manager, sales manager, accounts manager. Not that type of manager we are discussing. Okay, this here it is a special manager as per section number 196. Okay, so the person whom you are going to appoint as a manager as per section 196 need not be director. However, director can also be appointed as a manager. Hope that is clear. Next, if director vacates, then the position of managing director also vacates. Here, come to this example. Board of directors have appointed Mr. C as executive director. Now, if Mr. C resigns from his position as director, he will also automatically resigns from his position as executive director. Okay, but in case of managing director, in case of manager, that will not be the position. If a person resigns or vacates his office of director, he need not vacate his office of manager, because manager need not be a director. Okay, so vacation of office of director will not automatically vacate his position as a managing director, his position as a manager. But whereas In case you are a managing director or a whole-time director, then if you vacate your position as a director, then automatically you will be vacated from the office of managing director or the whole-time director, because managing director or whole-time director, he should be first of all a director. If he is not at all a director, then he cannot be managing director or whole-time director. The same is not the case in case of manager. Okay, if the person is not a director, even then he can act as a manager. Hope that is clear. That is a second difference. Next, substantial powers of management will be available with the managing director and whole-time director. Okay, almost 99% of powers to manage the company's business will be available with the managing director and whole-time director. With the manager also, mostly all the powers will be available. Okay, whole or substantially whole affairs of the company can be managed by the manager. Okay, that will depend based on the articles of association of the company. Okay, next. So here if you see, managing director and manager, more or less they are having same powers and they are involved in managing the company's business. So a company can appoint either managing directors or manager. Okay, a company cannot appoint both manager and managing director at the same time. Why? Because there might be there will be overlapping of power. If you appoint both the people, if you fill both the positions in your company, there will be overlapping of powers. So to avoid such overlapping, a company cannot appoint manager and managing director at the same time. Hope that is clear. You cannot appoint manager and managing director at the same time. A company can either have manager or managing director, but not both at the same time. Why? Because there will be overlapping of powers and a confusion will be created if you fill both the positions. Hope that is clear. Hey guys, since you are listening to this class till this point of time, I hope you are finding law classes very much engaging. Now, just like law classes for CA final, we are also having audit classes available on our website lecturepedia.in. Now, if you see at CA final level, most of the students will fail because of this audit subject, because since audit is a theory subject, people will feel difficult to remember it and they feel boring. Now, in order to make this audit subject engaging, we have started teaching audit subject with the help of PowerPoint presentations. If you see these PowerPoint presentations, they are very lively and very engaging. I'll just show you some of the sample presentations that we'll be using in our class. If you see, this is the PPT of SDG and ESG. You can find engaging images that are relevant to the content. Like this, for each and every chapter we will be using PowerPoint presentations. With the help of these PPTs, we will be discussing concepts in the class, and the same images that you find here, they'll also be available in the audit concise book that I will be giving you. Along with the classes, you will be getting this colorful concise book. This is a concept book that we will be using for audit in our class. See, the images that you find in the PPT is the same images you will also find in our books. And along with this audit concise, which is a concept book, you'll also be getting question and answer book. Even this question and answer book, it is a completely color book. And both in question and answer book and concise book, you will be finding the key terms highlighted in red color. Okay, so if you wish to purchase these classes, you can visit our website lecturepedia.in and you can place your order. Now you can continue listening your class. Next, what is the tenure of these executive directors? Now you have appointed a person as a managing director. Till how many years he can continue in that position? The tenure is 5 years. Okay, whether he can be reappointed, the answer is yes, he can be reappointed. However, the reappointment must be considered only in the last year. That means, let's say a person has been appointed for as managing director for 5 years. Now his reappointment should be considered only after completion of 4 years. That means in the last year, in the 5th year, you have to consider his reappointment. Hope that is clear. Reappointment is considered and made in the last year only. Next, now if you see in chapter number 1, section number 164, we have discussed disqualifications of directors, right? There, disqualification of director refers to non-executive director. Okay, non-executive director in the sense it will be applicable even for executive director also. Now here we will be discussing disqualifications for executive director. Okay, a person whom you are going to appoint as an executive director should not possess these disqualifications. Okay, if he has any of these disqualifications, then he cannot be appointed as a executive director. What are those disqualifications? Let's see, there will be 5 disqualifications. First one, disqualifications under section 164. Okay, disqualifications under section 164, there are 9 disqualifications that we have discussed, which are applicable to all the directors. Okay, so if a person is disqualified to be appointed as a director under section 164, how can he be appointed as an executive director, right? So if a person is disqualified under section 164, he is also disqualified to be appointed as a executive director. I have discussed some 9 points. Unsound mind, undischarged insolvent, he has been imprisoned for a period of more than 6 years, more than 6 months, and he has not paid his calls. So like this, there are some 9 disqualification points that we have discussed in section number 164, right? The company specific, individual specific default disqualification and the company specific default disqualification, we have discussed 164 subsection 1 and 164 subsection 2. Once you can refer the chart if you have forgotten those disqualifications. So that is the first disqualification for executive director. Next, age below 21 years or attained 70 years or more. Okay, if the person's age is below 21 years, then he is disqualified to be appointed as an executive director. If he has attained 70 years, then also he is disqualified to be appointed as an executive director. But there is an exception. If general meeting special resolution is passed, then you can appoint, or general meeting ordinary resolution plus central government approval is there, then you can appoint the person who has crossed 70 years of age as executive director. That we have discussed just now. Okay, in the above point we have discussed, if you see here, age above 70 years, right? Yeah. Now if you see, I'll be explaining you together section number 164 and section number 196 disqualifications. By comparing these two, we will be discussing. Okay, because the same type of disqualifications you will find in section 164 also for the director. So I will compare those two and I will explain you. Once I discuss these 5 points, then I will compare the disqualifications under section 164 and the disqualification under section 196. Okay, next, the person is undischarged insolvent or at any time adjudged as insolvent. Okay, this concept of insolvency I have already discussed in chapter number 1. If the person is undischarged insolvent, okay, still the court has not yet discharged him from insolvency, or at any time court has declared him as insolvent, in these two situations the person cannot be appointed as an executive director for the lifetime. Okay, for the lifetime you cannot act as an executive director if you have been declared as an insolvent by the court. Okay, next, at any time not paid dues to his personal creditors or made composition with them. Okay, if you have failed to pay dues to the creditors or you have made a composition with them, composition means to a particular bank you are liable to pay some 10 crores. Now you have entered into a composition agreement with the bank saying that I will pay only 7 crores. You please, write off remaining 3 crores. Like this, you have entered into a composition agreement with the bank. In this situation also, you cannot be appointed as a executive director for the lifetime. Okay, if you fail to pay the creditors, or if you have entered into composition agreement with the creditors at any time in the past, you will be ineligible to be appointed as a executive director. Next, at any time, you need to observe this term. It is saying at any time. Okay, at any time in the past, you have been convicted by court and sentenced for imprisonment of more than 6 months. Okay, if you have been convicted by court and if you have been sentenced for imprisonment of more than 6 months, in that situation also, you cannot be appointed as the executive director for the lifetime. Now we will compare these points of disqualification with the points of disqualification under section 164. Let us see. Okay, this will be very much interesting. First, age factor. Age factor. If the age of the person is less than 18 years, that means he is a minor. Minor will not be having the decision making capabilities, so he cannot be appointed as a director. Okay, since he is a minor, he cannot be appointed either as a executive director nor as a non-executive director if age is below 18 years. If age is more than 18, more than or equal to 18, but less than 21, in such a situation, you can act as a non-executive director, but you cannot act as an executive director, because to act as an executive director as per section number 196, your age should be more than 21 years, right? So if your age is less than 21, you cannot act as executive director, but you can act as non-executive director. Next, if your age is more than or equal to 21 but less than 70 years, in such a situation, you can act both as executive director as well as non-executive director. Next, if your age is above 70 years, in that situation, you can act as non-executive director, but in order to get appointed as executive director, you will require general meeting special resolution or general meeting ordinary resolution plus central government approval, right? The point that we have discussed. If you wanted to get appointed as executive director, in case your age is more than 70, then subject to the conditions, you can get appointed as a executive director even if your age is more than 70 years. Hope that is clear. Next, insolvency factor. See, we are discussing section number 196 and 164 in combination, because in section 164 also there are some disqualification points. In 196 also there are disqualification points on certain factors. So the common factors I have taken out and I am comparing them. Okay, so insolvency factor. Now generally, application for insolvency, it can be made either by yourself or some creditor might make an application. Let's say for example, Mr. A. Mr. A. Mr. A is Mr. A's assets are less than his liabilities, and he is not able to repay his liabilities. In this situation, application for insolvency can be made by Mr. A to the court by himself, or creditors are there na. These creditors can also make application to the court stating that Mr. A is not paying our amount, so you please declare him as insolvent and you please repay whatever the amount is realized from the assets. Like this, the application can be made by the creditors also. Okay, while discussing the insolvency bankruptcy code, we will be discussing these concepts. Now in these two situations, see, insolvency factor. Insolvency application made by self. Okay, the person by himself made the insolvency application. In such a situation, he cannot be executive director and non-executive director during the period till the court accepts the insolvency application. Okay, so during that period, he cannot be both executive director and non-executive director if the application is made by himself. After he makes the application, court ordered that person as a solvent. Okay, the person has made application. Once he makes the application, from that time he cannot act as executive director or non-executive director until the court gives the decision. Now court has observed everything and it has given order stating that this person is not insolvent, he is solvent only. His assets are more than his liabilities. With the assets he can repay his liabilities, so he is not insolvent, he is solvent only. Like this, the court has passed the order. In such a situation, since he is a solvent, he can act as both executive director and non-executive director. Hope that is clear. Next, if court ordered as insolvent but still undischarged. Now court is there now, court has ordered, has given an order stating that this person is a insolvent, but still it has not discharged this person from his liabilities. Okay, only when the assets have been sold and with those assets the liabilities have been paid, only then he will be discharged from the remaining unpaid liabilities. Still that discharging order is not passed. In such a situation, till since the he is a undischarged insolvent, okay, court decided him as insolvent, but still it has not discharged him from such insolvency. At that time also he cannot be executive director and non-executive director. Okay, this point we have discussed earlier also. Next, court has discharged him from insolvency. Now it has passed the discharge order stating that this person is not liable to pay the remaining liabilities. Okay, whatever the assets he is having, with those assets he has paid off the liabilities, and the remaining liabilities he is not having amount to repay. So I am discharging this person from those remaining liabilities. Like this, the discharge order has been passed by the court. Once such a discharge order has been passed, he can become non-executive director. Okay, after the court has discharged that person from his insolvency, he can act as non-executive director, but he cannot act as executive director for a lifetime. Okay, once the court declares you as an insolvent, whether you are discharged or undischarged, you cannot act as an executive director. But if you are discharged insolvent, then you can act as non-executive director. Hope that is clear. This is important point you need to observe. See, to understand all these points, first of all you should be clear with the difference between executive director and non-executive director. Only then you can properly understand all these points. Okay, next, if the application is made by creditors. See, in this situation, the application of insolvency is made by creditors. Okay, Mr. X, Mr. A is not repaying the creditors. So creditors made the application. In this situation, such person, Mr. A is there na, he can act as non-executive director, but he cannot become executive director. Okay, till the time court accepts or till the time court passes the order, he cannot become executive director. Now creditors have filed the application. During that period he cannot act as executive director, but he can act as non-executive director. If you observe in the first point, if he himself files the application, then during that period he cannot be both ED and NED, that is executive director and non-executive director. If the application is made by the creditors, then he can act as a non-executive director. Okay, because still it is not sure whether he is solvent or insolvent. In the first situation also it is not sure whether he is solvent or insolvent, but application is filed by himself. That means when he will file the application, he will file the application only when he feels that he is insolvent, right? But in case of second scenario, he might not be insolvent, but creditors don't know such fact na. Creditors, what they will think, he is not repaying our amount, that means he is not having amount to repay, that means his assets are not sufficient to repay liabilities, so he might be insolvent. So creditors, when application is made by the creditors, it is not 100% sure whether he is insolvent or not. That is the reason why he has been allowed to become a non-executive director, but he cannot become an executive director. Next, if court has ordered him as a solvent, then obviously he can act as both executive director and non-executive director. There is not an issue. There is no issue. But if court ordered him as insolvent and still he has not been discharged from his insolvency, in this situation obviously he cannot act as both executive director and non-executive director. Okay, cannot be both executive director and non-executive director. Now if the court has discharged him from his insolvency, in such situation he can become non-executive director but cannot become executive director for the lifetime. Hope that is clear. Here in these 2 points, the difference is, here you will observe the difference. Okay, here there will be a difference. Yeah, in this point there will be a difference, and yes, everything will be same except here everything remaining, all points will be same. Okay, next, so that is the insolvency factor. I have compared with respect to insolvency factor. Now coming to the imprisonment factor. If the person is imprisoned, then also he cannot be appointed as executive director, non-executive director, right? uh, the period of imprisonment, based on his period of imprisonment we will decide, right? So now if you see, if the period of imprisonment is for less than 6 months, if the period of imprisonment is less than 6 months, then obviously he can act as both executive director and non-executive director. If period of imprisonment is equal to 6 months, in such a situation he cannot be executive director and he cannot be non-executive director for a period of 5 years. Okay, next, if imprisonment period is more than 6 months but less than 7 years, in this situation he cannot be non-executive director for 5 years, same like this, but he cannot be executive director for the lifetime. Okay, if the period of imprisonment is more than 6 months, less than 7 years, he cannot be executive director for lifetime. Hope that is clear. This is important. If period of imprisonment is equal to 6 months, then he cannot be executive director for 5 years only. Okay, this we will derive from the section number 164. How we will derive? Basically section number 164 says what? Section, basically as per the disqualification under section 164, a person will be disqualified to act as a director if imprisonment is more than or equal to 6 months. So if imprisonment is equal to 6 months, he cannot be director. If he cannot be director, he can also not be executive director, and there the period is for 5 years. Okay, whereas 196 says is person is disqualified to be executive director if imprisonment is for more than 6 months. Here equal to point is not there, so if it is more than 6 months, then he cannot be executive director for lifetime and he cannot be non-executive director for 5 years. Hope you understood this point. Next, once you can read those 2 points together and you can observe this chart, then you will understand the logic. Okay, next, imprisonment of 7 years or more. If the person has been imprisoned for a period of 7 years or more, then he cannot be non-executive director and he also cannot be executive director for lifetime. Hope that is clear. So this is comparison of section number 164 and section number 196 disqualifications. Additional qualifications for executive director, basically under schedule 5, under schedule 5 section, sorry, schedule 5 part 1, we will be having these additional qualifications for the executive director. Basically in schedule 5 we are having 4 sections. I'll just show you. We'll also be discussing that entire schedule 5. I'll just show you. See, schedule 5, part 1, part 2, part 3, part 4. This part 1 is there na. This part 1 now we are going to discuss there. Additional eligibility conditions for executive director. Okay, apart from those 5 disqualifications, these additional 3 qualifications should be possessed by the executive director as per schedule 5, part 1. So what are those additional qualifications for executive director? He has not been sentenced to imprisonment for any period or fine exceeding 1000 under 19 specified acts. If you see your material, there you will find a list of 19 specified acts. Okay, income tax act, GST act, FEMA act, IBC, like this some 19 list of acts will be there. So the person should not have been convicted and imprisoned for any period, okay, under those 19 acts. Okay, even for one day also he should not be imprisoned under those 19 acts, and he should not be imposed any penalty of exceeding 1000 rupees under those 19 acts. Okay, if he has been imprisoned for at least one day under those 19 acts, he will be disqualified for a lifetime to be appointed as a executive director. Okay, that is the first qualification. Next, he has not been detained for any period under 𝗙ǐ Act. What is 𝗙ǐ Act? 𝗙ǐ Act stands for Conservation of Foreign Exchange and Prevention of Smuggling Act. Okay, this is 𝗙ǐ Act. So the person should not be detained for any period. For at least one day also he should not be detained under 𝗙ǐ Act. And he is present in India during last 12 months. That means he should be a resident director. Okay, he should be resident in India for at least 12 months. Past 12 months he should be in India. Only if these 3 additional conditions are also satisfied, he can act as executive director. Okay, so that is a discussion with respect to section number 196, appointment of executive directors. Hope that is clear. Now this is the major section. Actually the remaining all other sections, they will be very small. Okay, once we are done with the section number 196, remaining will be easily completed. Next, section number 203, appointment of key managerial personnel. Now if you see in section number 196, we have discussed appointment of 3 people. Who are they? Managing director, manager, and whole time director. These 3 people we have discussed. Now section number 203 also deals with appointment of key managerial personnel, KMP. While starting the chapter, I have told you there are 6 managerial personnel specified by the Companies Act. Now we will see who are those 6 key managerial personnel. Key managerial personnel: managing director, whole time director, manager. Okay, these 3 we have discussed in section number 196. Along with those 3, company secretary, chief executive officer, CEO, CFO, chief financial officer. Okay, these 3 people. Total 6 people. These 6 people will be treated as key managerial personnel as per Companies Act 2013. Now, how these key managerial personnel will be appointed, that we will see here. Now, if you see appointment of the first 3 key managerial personnel, we have already discussed in section number 196. So their appointment will be as per section 196 only. Remaining 3 people are there na, CS, CEO, CFO. Their appointment will be as per section number 203. You should not get confused here. Okay, hope that is clear. So for appointing managing director, whole-time director, manager, just a second. Yeah. So yeah. So for appointing managing director, whole-time director, manager, you'll appoint them as per section 196. Whereas CS, CO, CFO, they will be appointed as per section number 203. Basically, for appointing, you will be requiring board meeting ordinary resolution. Okay. For appointing company secretary, chief financial officer, CEO, board meeting ordinary resolution is sufficient. Whereas for appointing managing director, whole-time director, manager, you will require general meeting ordinary resolution or general meeting special resolution if age exceeds 70 years. Right. Now, applicability of whole-time key managerial personnel. Okay, to which companies these key managerial personnel must be there? Whole-time key managerial personnel means for the entire period they should be associated with this company only. That's the reason we are calling it them as whole time. Okay, so first of all, for listed companies or unlisted public companies having paid up share capital of 10 crore rupees. Okay, listed company and unlisted public company whose paid up share capital is more than 10 crore rupees. These two types of companies should appoint managing director or CEO or manager. If these three are not appointed, you should at least appoint whole-time director. So, listed company and unlisted public company whose share capital is more than 10 crores, they must appoint any one from these four. Okay, either managing director, CEO, manager, whole-time director. From these four positions, you should fill at least one position in your company if your company is a listed company or a public company having paid up share capital more than 10 crores. Next, you should also appoint a company secretary, a whole-time company secretary who should be an employee in your company. Okay, next, you should also have a CFO if your company is a listed company and paid up and unlisted public company having paid up share capital of more than 10 crores, then these three people you need to appoint. Okay, from these four, anyone, and CS, CFO you must appoint. Next, if your company is a private company and your paid up share capital is more than or equal to 10 crores. Okay, a private company whose paid up share capital is more than or equal to 10 crores must appoint company secretary. Okay, it need not appoint a whole-time director, the managing director, manager, CEO, CFO, all these people, they are not necessary. But company secretary has to be appointed for the private company whose paid up share capital is more than or equal to 10 crore rupees. Hope that is clear. Next, another important point. Chairperson of company cannot be appointed as CEO or managing director of company unless generally company it will be having a chairperson, right? The main person, chairperson. This is the position in the company. Now, this chairperson cannot be appointed as CEO or managing director. Okay, you cannot appoint the same person as a CEO or managing director because these positions are there now. Basically, the position of chairperson is higher. Okay, the topmost position in the company is chairperson. Okay, under chairperson there will be these positions: CEO, MD. Now, if the same person is appointed as a chairperson and CEO or MD, then what is the use of appointing? Okay, there is no use of this hierarchy. That is the reason why the person who is chairperson of a company cannot be appointed as CEO or managing director of the company. Here managing director includes all: whole time director, managing director, manager. Okay, but there are some exceptions. There are two exceptions. That means in those two exceptional cases, you can appoint the chairperson of the company as CEO or the managing director. What are those two exceptions? The first exception: AOA permits the same. Okay, in the articles of association, there is a specific provision stating that the chairperson of our company can be appointed as either the managing director or the CEO. Okay, the both the positions, the position of chairperson and the position of managing director or CEO, can be occupied by same person. Like this, a provision is there in the articles of association. This is the first exception. Okay, in this situation you can appoint. Second situation: it is a public company with paid up share capital more than or equal to 100 crores and turnover is more than or equal to 1000 crores and engaged in multiple businesses. In this situation also you can appoint the chairperson as managing director as well as the as managing director or the CEO. Now if you see Reliance Industries, for Reliance Industries, Mukesh Ambani is the chairperson and he is also the managing director of Reliance Industries, because they are falling in this criteria. It is a public company. Reliance Industries is a public company. Its paid up share capital is more than or equal to 100 crores and its turnover is also more than 1000 crores and it is engaged in multiple businesses. Since all the conditions are satisfied, they have appointed the chairperson of the company, that is Mukesh Ambani, as managing director also. Hope that is clear. Another important point: one person cannot act as whole-time key managerial one person can act as whole-time key managerial personnel only in one company at a time. See, a person can act as whole-time key managerial personnel. Whole-time key managerial personnel means managing director, manager, whole-time director, CS, CEO, CF. Okay, a person can occupy these six positions only in any of these six positions only in one company. Okay, he cannot be key managerial personnel in more than one companies. Why? Because key managerial personnel or the whole time key managerial personnel itself means that his entire time he will allocate for that company only, right? So since he will be allocating entire time for only that company, he cannot be appointed as the managing director, as the key managerial personnel for the second company. Okay, but there are exceptions for this also. What are those exceptions? There is a limited. There is a limited. Now in the a limited, Mr. X is a key managerial personnel. Key managerial personnel means any of the six positions he is holding. Okay, any one of those six positions he is holding. Now the rule is he cannot be appointed as key managerial personnel in another company, right? That is a general rule. Mr. X cannot be appointed as key managerial personnel in another company. But the exception, there are two exceptions. Speaking about the first exception, exception 1. Now A limited is having a subsidiary. Okay, subsidiary company. Now Mr. X can act as key managerial personnel of this subsidiary company. This is exception 1. Okay, so the person can act as key managerial personnel of the subsidiary of the company in which he is already acting as a key managerial personnel. This is the first exception. Second exception. Exception number 2. Now, this Mr. X is there, na? He is either, just a second, he is either managing director or manager of A Limited. Okay, Mr. X is managing director or manager of the 6 positions of key managerial personnel, that is managing director, whole-time director, manager, CS, CEO, CF. Of these 6 positions, Mr. X is occupying the position of either managing director or manager. In this situation, Mr. X can hold another position of managing director in B Limited. Okay, in second company also he can get appointed as managing director, provided the board of directors of B Limited give unanimous approval for appointing Mr. X as managing director of their company. This is the exception number 2. Okay, see, the general rule is that a person can occupy the position of a key managerial personnel in only one company. There are 2 exceptions to this. The first exception, the person who is acting as a key managerial personnel of a company can also act as a key managerial personnel of its subsidiary company. This is the first exception. Second exception, if the person is acting as either managing director or manager of a company, then he can get appointed as a managing director of a second company, provided in that second company board of directors provide a unanimous approval for appointing such a person as a managing director. These are the 2 exceptions for the rule. Hope you understood this. Next, casual vacancy of whole-time key managerial personnel. If there is a casual vacancy created in the office of whole-time key managerial personnel, it needs to be filled within 6 months. Okay, by board meeting ordinary resolution. Hope that is a section number 203. Okay, now moving to section number 197. Now till now we have discussed about appointment of key managerial personnel. If you see the name of the chapter, it is speaking about 2 aspects. One is appointment and remuneration of key managerial personnel. So one aspect we have completed, which is appointment aspect. Now we are entering into the second aspect, which is remuneration aspect, starting with section number 197, which deals with overall maximum managerial remuneration that can be paid. Okay, so company cannot give as much as remuneration as it wanted to the directors. There is certain limit that has been fixed on the company. So we'll see those limits. I have bifurcated into 2 parts. First one, maximum remuneration that can be paid to executive directors, and the maximum remuneration that can be paid to non-executive directors. Okay, first of all, remuneration to executive directors, remuneration to non-executive directors. First of all, we'll discuss about remuneration to executive directors. That means managing director, whole-time director, manager, right? Now, if the company is having profits, okay, in case of profits, if the company is having profits and the company is having only one executive director, in such a situation, the maximum remuneration that you can pay to such executive director is 5% of net profit of the company. Okay, so if the company is having profits and the company is having only one executive director, in such situation the maximum remuneration that you can pay to that one executive director is 5% of net profit of the company. Okay, now this net profit is there na, for this net profit has to be calculated as per section number 198. There are some additions and deletions that has to be made to the actual profit that you derive from the profit and loss statement. Okay, so those points of additions and deletions you can just go through section number 198 and you can read them. Okay, I have not given those points of additions and deletions here in this chart. Okay, those are easy points itself. You can just go through those list of additions and deletions from the study material. Okay, so by following section number 198 you have to calculate the net profit. Once the net profit once you have arrived at the net profit, on this net profit you have to apply 5%. Okay, so that is the maximum amount of remuneration which you can pay to the executive director if the company is having only one executive director and the company is having profits. If the company is having more than one executive director, in such situation maximum 10% of the net profit you can pay to the all those executive directors. Okay, to all the executive directors maximum 10% you can pay. Next, in case the company is having loss, if the company is having loss, then the remuneration that you can pay to the directors, the executive directors, is as per schedule number 5. Schedule 5 has prescribed certain slabs based on the effective capital. We will discuss that effective capital. Okay, after this section is completed we will discuss that. Okay, schedule 5 limits in case of losses. Okay, we'll discuss that. So if the company is having profits, then it can pay 5%, 10%. If it is having losses, then as per schedule 5. Next, coming to the non-executive directors, here also again same bifurcation. If the company is having profits, and here you need to observe the amount of remuneration that you pay to non-executive director depends on number of executive directors the company is having. Okay, see, if the company is having executive directors, in such a situation the maximum remuneration that you can pay to non-executive director is 1% of net profit to all the non-executive directors, not to single non-executive directors. Okay, taken all the non-executive directors together, the maximum remuneration that you can pay is 1% of the net profit if the company is having executive directors. If the company is not having executive directors, in such a situation maximum 3% of the net profit you can pay as a remuneration to all the non-executive directors taken together. Hope that is clear. And in case of losses, obviously as per schedule 5 we will see. This is a remuneration that you can pay to the executive directors and the non-executive directors. Now there are certain points. We have seen individual limits for executive director and individual limits for non-executive directors. Overall, okay, for both executive directors and the non-executive directors, on a overall basis, the maximum remuneration that you can pay to both non-executive and executive directors taken together should not exceed 11% of the net profit. Okay, see, overall remuneration to all executive directors and non-executive directors cannot be more than 11% of the net profit. That means of the total net profit you earn, okay, of the total net profit that the company earns, maximum 11% can be spent in the form of remuneration to the directors. Hope that is clear. However, this net profit you have to calculate as per section number 198. Okay, this net profit is not the net profit that you directly arrive from the profit and loss statement. Okay, for the net profit that you arrive from the profit and loss statement, you have to make certain additions and you have to make certain deletions as per section number 198. On that net profit you have to apply these percentages. Hope that is clear. Next, to give excess of above said limits, general meeting ordinary resolution is required. Now Act has specified these limits: 5% of net profit, 10% of net profit, 1% of net profit, 3% of net profit, 11% of net profit. These are the limits specified by the Act. Now, if the company wants to give more than these limits, company can do so by passing general meeting ordinary resolution. Hope that is clear. Next, above percentages are exclusive of sitting fees. What is this sitting fees? Basically, board of directors, for attending the board meeting, they will be given certain fee by the company. Okay, that fee is known as sitting fee. So these percentages is there, these remuneration percentages, those percentages are exclusive of sitting fees. Okay, for calculating this 5% of maximum remuneration, you should not include the sitting fees, okay, into the remuneration. Apart from sitting fee, you can receive these percentages as remuneration. Hope that is clear. Now, sitting fees. Firstly, the sitting fee, it can be paid to both executive director as well as non-executive director, and the maximum sitting fee that you can pay is 1 lakh per director. Okay, per director you can pay maximum of 1 lakh as sitting fees, and sitting fee of independent director and women director, it should not be less than that you pay to the other directors. Okay, the sitting fee that you pay to independent director and the women director, you should match it with the sitting fee that you pay to the other directors. Hope that is clear. Now we'll move to schedule 5. That is, here in this chart we have discussed the remuneration that you can pay in case the company is having profits. If the company is having loss, then also certain limits have been prescribed. See, schedule 5 limits. If the company is having losses, then what is the maximum amount of remuneration that you can pay to executive directors, that you can pay to non-executive directors? This will depend on the effective capital. What is this effective capital? Based on the effective capital, first of all, we will see what is meant by effective capital. For calculating effective capital, you have to add paid up share capital, free reserves, securities premium, long term loans that the company has taken, long term deposits that the company has taken, and the long term debentures that the company has issued. You have to add all these 6 items to arrive at effective share capital. So what is effective capital? Paid up share capital, free reserves, securities premium, long term borrowings, long term deposits, long term debentures. All these 6 taken together will be known as effective capital. Now, the amount of remuneration that you can pay to the directors in case of losses depends on this effective capital. See, now for these items, from these items, you have to reduce investments that you have made, preliminary expenses that you have incurred, accumulated losses. Okay, these 3 items you have to reduce to arrive at the effective capital. Okay, now the amount of remuneration, the maximum remuneration that you can pay is dependent on the effective capital. If the effective capital that you have calculated as per above calculation is negative or less than 5 crores, in such situation, the maximum remuneration that you can pay to executive director, see, this is per executive director per year is 60 lakhs, and per non-executive director per year is 12 lakhs. If effective capital is 5 crore to 100 crore, then per executive director per year you can pay 84 lakhs, maximum 84 lakhs. Per non-executive director per year you can pay maximum 17 lakhs. If effective capital is 100 crore to 250 crore, then per executive director 120 lakhs, per non-executive director 24 lakhs. If effective capital is 250 crore and above, then 120 lakhs plus 0.01% of effective capital in excess of 250 crores per executive director, 24 lakhs plus 0.01% of effective capital in excess of 250 crores per non-executive director. Okay, these are the maximum limits of remuneration that you can pay to non-executive directors and executive directors in case of losses. Obviously, if you wanted to pay more than these limits, general meeting ordinary resolution is required. Okay. Next, item B. Basically, in schedule 5, I have told you there are 4 parts, right? The first part, it has dealt with additional qualifications for executive director. The 3 qualifications, Coffee Posa Act and those 19 acts, the 3 qualifications that is dealt by part 1. Part 2 is there, na? Part 2 of schedule 5. That part 2 of schedule 5 deals with the maximum remuneration that you can pay in case of losses. See, if you see schedule 5 of Companies Act, part 1 we have already discussed. Part 2 is there, na? Part, sorry, in part 2 again there are 5 sections. Okay, again there are 5 sections. In those 5 sections of part 2, second section deals with the remuneration that you pay to the directors in case of losses. First section deals with the remuneration you pay to the directors in case of profits. Okay, in case of profits, what is the remuneration that you will pay? 5% and 10% to the executive director, 1% and 3% to the non-executive directors, overall 11%. That concept of 5%, 10%, 1%, 3%, 11% is there, na? That is discussed in section 1, part 2 of schedule 5. And losses, that table is there, na, based on effective capital. That table is discussed in section 2. Okay, remuneration to directors in case losses or inadequate profits. This section 2 is having item A and item B. Item A is that chart, that table that we have discussed, okay, based on effective capital, general meeting, ordinary resolution, special resolution. Just a second, here I have told you special resolution, right? It is, yeah, ordinary resolution, right? This is special resolution. Generally, if company wanted to give remuneration as per these limits in case of losses, it has to pass general meeting ordinary resolution. In case of losses, if it wanted to give in excess of these limits, then it has to pass general meeting special resolution. Hope that is clear. So that is item A. And item B deals with remuneration to director in professional capacity. What is professional capacity? Let's say, for example, there is a person, Mr. X. Mr. X is a doctor by his profession, and here he is also appointed as a director in his hospital. Okay, he is having a hospital. In that hospital, he has been appointed as a director. So now he is serving as a director in that hospital in his professional capacity. So in such a situation, what is the remuneration that can be paid to him? Will be dealt by item B. See, for a director who is also working in professional capacity, remuneration as per item A, okay, item A can be paid if, okay, that hospital it is incurring losses. In such a situation, you can pay remuneration to that director who is acting in professional capacity as per the limits prescribed in item A if the following conditions are satisfied. Now, generally, for that person who is Mr. A, he is working as doctor in that hospital and he is also director. Now, for acting as a doctor, his fee he will receive from the company. Okay, his professional fee he will receive. For acting as a director, he has to again receive the remuneration. Right. Now, if that hospital is running into losses, to pay remuneration to that director who is acting in his professional capacity, he need to satisfy 3 conditions. Only then he can be given remuneration as a director. Otherwise, he will be given only his professional fee for acting as a doctor. Okay. Now, what are those 3 conditions? First of all, he is not having interest in capital of company or holding or subsidiary of that company. Okay, he should not be holding any shares in that company, holding company, subsidiary company. However, up to maximum of 0.5% is permitted. Okay, beyond 0.5% he should not hold. Okay, next, he is not related to director, promoter of company, holding company, subsidiary company in the last 2 years before the appointment. Okay, he should not be relative of the director or promoter of the company, holding company, subsidiary company. Next, he should possess graduate level qualification with expertise in the field in which the company operates. Okay, he is acting in his professional capacity now. In order to act in his professional capacity, he should possess the required level of education. Okay, he should possess graduate level of qualification that is necessary for that particular company. Hope you are clear with this. Only if these are satisfied, he can be given remuneration in his capacity as a director, even though the company is incurring losses as per these limits. Okay, as per item A limits. Apart from that, additional conditions. First of all, in order to give remuneration, board meeting ordinary resolution, however it is necessary. Okay, and approval of nomination remuneration committee is also required. Okay, if you are paying remuneration to the directors in case of losses, approval from nomination remuneration committee is also required. Okay, because company is incurring losses on one side, on the other hand you are paying remuneration to the directors, so here a lot of approvals have been kept. Okay, first of all, board meeting ordinary resolution required. Then approval from nomination remuneration committee is required. Next, company should not be default in payment of debts, deposits, interest. If defaulted, take approval. Okay, the company, it should not have defaulted in making payments to its creditors. It should not be defaulted in repaying its deposits. It should not be defaulted in repaying the interest. Okay, why? Because on the one side, company has defaulted in paying the creditors. On the other side, it is paying remuneration to the directors. How it will be possible? You first of all pay to those creditors. That is the reason why the act says, in order to pay remuneration to the directors in case of losses, there should not be any default to the creditors. Okay, if in case there has been any default to the creditors, take approval from those creditors that we have defaulted you and we wanted to pay remuneration to the directors. Obviously those creditors will not give approval. Okay, on one hand you are not paying to us and you are paying to the directors, like this the creditors will say. So act has said that if defaulted, take approval of the creditors to pay remuneration to the directors in case of losses. Okay, next, general meeting ordinary resolution or general meeting special resolution for item A. Okay, if you want to give the remuneration as per the within the limits of item A, general meeting ordinary resolution sufficient. If you wanted to give the remuneration in excess of the limits prescribed in item A, general meeting special resolution is required. Next, general meeting special resolution for item B. This is valid for 3 years. Okay, if you wanted to give remuneration to the person who is acting in his professional capacity as a director, then you have to take general meeting special resolution, and that special resolution will be valid for 3 years. Hope that is clear. Now moving to the schedule 5. In schedule 5, we have discussed part 1. In part 2 also, the first two sections we have discussed. Moving to section 3. Section 3 of part 2. Now section 3, it deals with certain special scenarios. See, director remuneration in case of losses, special cases. Okay, the company has incurred losses and it wanted to pay remuneration to directors in certain special scenarios. There are 5 special scenarios. What are those 5 special scenarios? Let us see. First special scenario, remuneration is paid by other company which is a foreign company or company which got ordinary resolution from the shareholders, provided such remuneration is within the limits of section 197 for such company, and such company shall be profit making company. What is this point? Let me explain you. There is A limited. In the A limited, there are 3 directors. Okay, Mr. A, Mr. B, Mr. C. There are 3 directors in A limited, and obviously A limited is incurring losses. Now A limited wanted to pay remuneration to this A, B, C. what it has done is, there is another company B Limited. Okay, on behalf of A Limited, B Limited is paying remuneration to these three directors. To allow this, certain four conditions should be satisfied. What are those four conditions? First of all, this B Limited is either a foreign company or got approval from shareholders. Shareholders means general meeting. General meeting, ordinary resolution. Okay, in the general meeting of B Limited, from the shareholders of B Limited, approval has to be received, stating that B Limited will pay remuneration of A Limited's director. Okay, next. And third condition, B Limited should be profit making company. Should be profit making company. If it is a profit making company, remuneration will be paid as per section 197. Section 197 limits should not be crossed. However, this is taken together directors of both. Okay, see, remuneration of directors of A Limited plus B Limited should be within section 197 limits. That is 5%, 10%, 1%, 3%, 11%. If these conditions are satisfied, then B Limited can pay remuneration to the directors of A Limited. Now we will read that point, you will understand. These are certain special scenarios which are permitted by Companies Act. See, in these special scenarios, can pay remuneration in excess of section 3 limits in case of losses. See, remuneration is paid by other company which is a foreign company or company which got ordinary resolution from shareholders, provided such remuneration is within limits of section 197. Okay, 1%, 3%, 5%, 11% for such company, and such company shall be profit making company. Hope that is clear. However, for making this, additional three conditions should be satisfied. Okay, for making this payment, additional three conditions should be satisfied. We will see. Next, second special scenario, 𝗙cie company as declared by BIFR. BIFR means Board for Industrial Financial Reconstruction. Okay, BIFR has declared a particular company as a 𝗙cie company. Now this 𝗙cie company can pay remuneration in excess of section 2 limits. Okay, as per section 2 limits, it can pay if the effective capital is okay, as per that limits, it can pay by passing general meetings ordinary resolution. If in excess of those limits it wanted to pay, it can pay by satisfying if these three conditions are satisfied. Okay, and this can be paid for 5 years. We will discuss those three conditions. Next, company to whom resolution plan under IBC is approved. Okay, against a company, an insolvency petition has been filed and the tribunal has approved that insolvency plan, sorry, has approved that insolvency petition, and resolution plan has also been received, and that resolution plan is being implemented. In such a situation, for that company also, till 5 years the remuneration can be paid to the directors in excess of those limits subject to the conditions. Next, newly incorporated companies up to 7 years in excess of the limits can be paid. Next, remuneration fixed by BIFR or NCLT. If the NCLT or BIFR itself fixes any additional remuneration in excess of the limits, that can be paid, subject to C. Apart from conditions specified in section 2, following conditions should also be satisfied in these 5 scenarios. Okay, these additional 3 conditions that we are going to discuss need to be satisfied only in these 5 scenarios. Okay, in remaining all other scenarios, just by giving general meeting ordinary resolution or general meeting special resolution, you can give the remuneration as per item A. Okay, section 2 item A limits. But in these 5 scenarios, these 3 additional conditions should also be satisfied along with the section 2 conditions. See, first one, managerial personnel should not receive remuneration from any other company. Okay, the managerial personnel to whom you are giving to remuneration in any of these 5 cases should not be receiving the remuneration from any other company. Okay, he should be receiving remuneration only from your company. Next, auditor or company secretary should give a certificate that creditors and term lenders agreed for appointment and remuneration. Okay, auditor and the company secretary, either auditor or company secretary, should give a certificate to the company stating that the creditors of this company have approved for giving remuneration in excess of the limits to the directors. Okay, such certificate has to be given by the auditor or the company secretary. Next, auditor or company secretary should give a certificate that no default in payment to the creditors and deposit holders. Okay, subject to these 3 conditions, you can pay the remuneration in excess of section 2 item A limits in these 5 scenarios. Hope that is clear. These are the special scenarios. That is section 3. Moving to section 4 of part 2. Perquisites not to be included in the remuneration. Okay, while calculating these limits of remuneration, you need not include the amount of perquisites that have been given to the directors. Next, see, perquisites means like free car, home. Okay, these perquisites, it should not be given, included, not given. It can be given, they should not be included in the remuneration for these limits. Okay, next, receipt of remuneration from 2 companies. See, if the director is receiving remuneration from 2 companies, then his total remuneration should not exceed the maximum permissible remuneration of the company. Let me give you an example. A limited, B limited. Okay, now Mr. X is director in A limited as well as B limited. Now, the maximum remuneration that Mr. X can receive, how much? Let's see. Remuneration of, basically the remuneration, it will be calculated on a percentage of net profit, right? So now net profit of A limited is 100 crore. Okay, and net profit of B limited is, let's say, 200 crore. Now, in A limited, Mr. X is the only managing director. So it has given 5% of net profit as remuneration to Mr. X. It can give maximum 5% of remuneration to Mr. X. 5% of 100 crores means 5 crore. So this is the maximum remuneration that he can get from A limited. Next, from B limited, let's say in the B limited, there are some 3 directors. Since there are more than one executive director, maximum remuneration that can be given to all the directors is 10% of 200 crore. So 10% of 200 crore means 20 crore. Okay, now the maximum remuneration that Mr. X can receive is higher of these 2, which is 20 crore. Okay, this is the maximum remuneration that Mr. X can receive. Okay, the maximum remuneration that Mr. X can receive is higher of permissible limits of the companies in which he is a director. Hope that is clear. That is said in section number 5. Next, part 3 of schedule 5, provisions applicable to part 1 and part 2. Basically, for giving the remuneration as per part 1 and part 2, general meeting, special resolution or ordinary resolution is required based on the respective scenario, and auditor or CS has to give certificate on schedule 5 compliance. Okay, if the company is having losses, then auditor or the company secretary has to give a certificate to the company stating that company has complied with the requirements of schedule 5. Okay, this is known as schedule 5 compliance certificate, which has to be given by the auditor or the company secretary. Next, part 4, exemption by central government. Okay, central government, if it wanted, it can grant exemption from schedule 5 to any of the company it wanted. Okay, so that feasibility is kept in part number 4 of schedule 5. So this is schedule 5 discussion. Now moving to, almost we have completed entire chapter. Still there are some minor sections. We will be done with these sections in within 10 minutes. We will be completing this chapter. Now, section 200, factors to be considered for remuneration in case of loss or inadequate profits. See, if the company is incurring losses, then while giving remuneration to the directors, you have to consider certain points. Okay, before giving remuneration to the directors in case of losses, you have to consider certain points. What are they? Company's financial position. Okay, before you decide amount of remuneration you are going to pay to the directors, once you have to keep in mind the financial position of the company. Okay, next, remuneration or commission in other capacity. Okay, before you are giving remuneration to the director, you should also consider the amount that he is getting from the company in other capacity. Okay, based on that you have to decide the remuneration that you are giving to the director, because the company is incurring losses. Okay, next, remuneration or commission from other company. Okay, you should also consider the remuneration or the commission that the director is receiving from other company. Okay, if he is receiving more remuneration from other company, since your company is incurring losses, you can give less remuneration. Okay, so you have to consider this point before deciding amount of remuneration in case of losses. Next, professional qualification of the director also you should consider before deciding the remuneration. Okay, you have to give the remuneration based on his qualification. Okay, next, other matters you need to consider before deciding the amount of remuneration that you give to the director in case of losses. Next, section number 199, recovery of managerial remuneration in certain cases. See, once you have paid managerial remuneration, once you have paid remuneration to the directors, whether you can recover it. Let me tell you a situation. Basically, the amount of remuneration that you pay to the director, it will depend on the net profit of the company, right? 3% of net profit, 1% of net profit, 5% of net profit. This is the limits. Now, let's say you have prepared your financial statements and you have arrived at a net profit. On this net profit, you have calculated, let's say 5%. Your company is having only, one director, one executive director. So 5% you have applied and you have given it to the executive director as a remuneration. Later on, after 1 week or 2 weeks, you have found that there is some mistake in preparing financial statements. So you have revised the financial statements. When you have revised the financial statements, the amount of profit has reduced. Now, if amount of profit reduces, the amount of remuneration also reduces, because remuneration is calculated as a percent of profit. So, since the remuneration also reduces because of reduced profit, you have to recover the excess remuneration that you have already paid to the director. Hope this is clear. So, this feasibility is provided by section number 199. See, company is required to restate financial statement due to fraud or other non-compliance. In such a situation, due to this, there is a change in the remuneration already paid. Then excess remuneration will be recovered by the company. Okay, company can recover the excess remuneration that it has already paid. As per section number 199, it can recover. Next, section number 204, which deals with secretarial audit. Just like statutory audit, which will be done by the the chartered accountants, there will be secretarial audit, which will deal with the compliances as per the Companies Act. Whether all the Companies Act secretarial issues have been complied with or not will be checked in the secretarial audit, and this secretarial audit will be done by company secretary. So to whom this secretarial audit is mandatory? First of all, for all the listed companies, secretarial audit is mandatory. And for every public company whose paid up share capital is more than or equal to 50 crore, or turnover is more than or equal to 250 crore, or outstanding loans borrowing from bank is more than or equal to 100 crore. Okay, if any one of these condition is satisfied, then for such public companies secretarial audit becomes mandatory, and the secretarial audit report will be given in format of form MR3, and it will be given as an annexure to the board report. Hope that is clear. Next, section number 202. This is the final section. There will be section number 205, which deals with powers and duties of company secretary. That is a simple section, you can go through that. Okay, that section I have not given here. Those points, they are not much important, you can just go through yourself through the book. Okay, now the final section, section number 202, compensation for loss of office of managing director, whole time director, or manager. Now, when this payment can be made to the uh, executive director? Okay, basically this is dealing with compensation for loss of office. Okay, you are compensating the executive director because he has lost his office. Okay, this, in which situation you can pay this compensation? See, when payment can be made: compensation for loss of office, or consideration for retirement from office. Okay, if the executive director retires from his office, or he has been removed unnecessarily from the office, or in connection with such loss or retirement, you can pay this compensation either to managing director, whole time director, manager. Okay, compensation for loss of office can be paid only to any of these, only to these people. Okay, managing director, whole time director, manager. Okay, only for these three people compensation for loss of office can be paid. Okay, for other people it is not mandatory. Okay, now in the following situations you will not make such payment for compensation of loss of office. What are those situations? Director resigns as part of reconstruction and appointed in new restructured company. Let's say there is A limited, there is B limited. In A limited there are two directors, X and Y. Okay, now A limited is merging with B limited. Since A limited is merging with the B limited, Mr. X and Mr. Y have to retire from A limited. After merging, AB limited is formed. Now Mr. X and Mr. Y are appointed as directors in the AB limited. In this situation, they have resigned because of amalgamation. However, in the new company, they are again appointed. So effectively, there is no loss of office here. So you will not pay any compensation here. Hope that is clear. Next, director resigns on his own. Okay, director, he resigns on his own. Okay, company has not removed him. Director on his own he retires. In such situation also you will not pay any compensation. Okay, if company, because of its position or because it is not able to, it is not in a position to pay the remuneration, okay, if because of those reasons company wantedly removes the director, then company will pay some compensation because abruptly it has removed the executive director. But here the executive director he himself resigned, then why will you pay the compensation? Okay, next, office of director vacated under section 167. Okay, under section 167 there are points of vacation. If office of director has been vacated due to those points of vacation, then also you will not give any compensation. Next, company is being wound up due to negligence or default of the director. Okay, because of negligence or default of that executive director himself, the company is being wound up. Okay, if the company is being wound up because of that person only, in such situation why will you give compensation to that person? You will not give compensation for such person because he himself is the reason why company is being wound up. Okay, If he has worked properly, company would have not been wound up and his position would be there as it is. Okay, he is being resigned, he is being coming out of the company because company is wound up, company is being wound up, and company is being wound up because of negligence of that person. So why will you give remuneration to why will you give compensation to that person? You will not give. Next, director is guilty of fraud or breach of trust. Okay, director is being removed from his office because some fraudulent activity has been done by him or a breach of trust has been done by him. In such situation also, you will not give remuneration to that person. Next, not the remuneration, you will not give compensation to that person. Now, how you will calculate how much of compensation has to be given? See, the points that you need to remember is, first of all, compensation will be given only to managing director, full-time director, manager. Okay, only to these people Companies Act says compensation can be given. When it will be given? If company abruptly removes them from their office. Okay, there is no wrong on them. Okay, company is, let's say for example, company is in bad situation, it is not able to pay high salaries for these executive people, so it is removing them in middle of their tenure. So here no wrong has been committed by those people, company only removing them. Since the company only removing them, for the loss that they have incurred, okay, for the loss that the executive directors have incurred because of loss of their office, some compensation will be given by the company. This is the situation. Now here, how much compensation has to be given? Quantum of compensation. See, quantum of compensation shall not exceed remuneration he would have received if he would have been in the office for the remainder of his term or 3 years, whichever is shorter. Now let's say, and I will explain you entirely after reading fourth point also. Calculation of compensation on the basis of average remuneration earned during 3 preceding years from the date he ceased to hold such office. Now, Mr. X. Mr. X, originally he has been appointed for 5 years. Okay. Now, after completing 1 year, okay, after completing 1 year, he is being removed from the office. That means balance years will be balance 4 years. So he will be given remuneration for the balance of years that he would have been there in the office if he has not been removed, or 3 years, whichever is lower. So now his compensation will be calculated for 3 years. Okay. Next scenario, if he has been removed after completing 4 years, okay, after completing 4 years as an executive director, he has removed. Now balance will be 1 year or 3 years, whichever is lower. Here 1 year is lower, right? Here 1 year is lower, so his compensation will be calculated for 1 year only. Okay, now how the compensation will be calculated? Let's say in the past 4 years, on an average, he received compensation of he received remuneration of 10 lakh per annum, or let's say year 1, in the past 4 years, year 1 he received 10 lakh, year 2 he received 15 lakh, okay, year 3 he again received 15 lakh, year 4 he received 20 lakh. Now you will do average of all these: 10, 20, 30, 50, 60. 60 lakh by 4, how much you will get? 15 lakh per annum. Okay, on average he received 15 lakh remuneration. So here his compensation in this scenario will be 1 year multiplied by 15 lakh. So his compensation will be 15 lakh. Hope that is clear. Let's say in this first situation also his average remuneration, uh, sorry, he has worked only for 1 year na? So in that 1 year, let's say he received 10 lakh as a remuneration. Average remuneration will also be 10 lakh only. So here his compensation will be 3 years multiplied by 10, which is 30 lakh. Hope that is clear. So 30 lakhs will be the remuneration, sorry, 30 lakhs will be the compensation that he will receive. This is how you will calculate the compensation for loss of office. Another point, no compensation to be paid if winding up of company commenced before the date on which he ceased to hold the office or within 12 months after the date on which he ceased to hold the office and assets on winding up are not sufficient to repay the shareholders. Now you will not pay the compensation to the executive director if company is being wound up at the time of his removal of the office, or within 12 months from the date he lost his office, company is being wound up within 12 months. In such situation also you will not pay compensation to the executive director for loss of office. Okay, during that winding up, if the assets are not sufficient to repay the liabilities, then you will not give the compensation. Okay, if the assets are sufficient to pay the liabilities, after paying liabilities also still there are assets, then you can think of paying compensation to the loss of office of the director. But in case of winding up, if assets are not sufficient to pay the liabilities itself, you cannot pay the compensation to the directors for loss of office. Hope that is clear. So by this we have completed discussion of second chapter. In the next class we'll be starting with the third chapter. Okay, and I'll be winding up this class as of now. Until then, take care. Bye bye. See you.